a little bit of a difference because a 15-year mortgage usually has a lower interest rate than a 30-year mortgage. Okay, so I want to keep this in terms that make sure we're not comparing apples to oranges. We want to compare apples to apples. I'm going to use a mortgage tax bracket today of say 25%. Now here's a little math question for you. So if you were to take the difference in mortgage payment between the 15-year mortgage and the 30-year mortgage, plus the tax savings, and you put the, because you get extra tax savings out of a 30-year mortgage. I'll go through that in a second. But if you took that money and put it in a side fund, okay, your savings account per se, what rate of return do you think you'd have to have on that money to actually have your 30-year mortgage paid off in 15 years? Take a wild guess and write it down. Oops, sorry. You'd have to earn 5.522% on the difference in payment with the extra tax savings. And read this for yourself if you want. I'm going to give you a second here. Okay, now assuming you can make 7.5% in that side fund, take a wild guess what kind of interest rate you'd have to earn on that money to have your 30-year mortgage pay off in 15 years. You can actually have your house paid off in 14 years and 0 months. So if your goal is to pay your house off faster, there's a safer way to do it, okay? And you actually have it paid off a lot faster. But your money's working harder for you, so I'm not sure if I would personally do that. So did you realize there's more tax savings in the first 15 years of a 30-year mortgage than there is in all 15 years of a 15-year mortgage? And if you go to 30 years, take the loan for the full 30 years, you save an extra $25,000+ in taxes. Okay? So like I said, you can go back and review this many times if you need to, okay, to have everything really understand it. But now I want to give you that quiz again. True or false? A large down payment will save you more money over time than a small down payment. We will go back to that $20,000 part. We put $20,000 down. If you didn't put $20,000 down, it would have earned $22,000 in interest for you over 10 years. A 15-year mortgage will save you more money over time than a 30-year mortgage. Now we saw that that wasn't necessarily true either because the compounding interest effect in the last slide, a couple slides ago. Okay, making extra principal payment saves you money. Well, we saw that you're better off putting the money somewhere else and making compounding interest on it. The interest rate is the main factor in determining the cost of a mortgage. That's that 15-year versus 30-year mortgage. We saw that that wasn't necessarily true. And you're more secure having your home paid off than financed 100%. So let me go through some life examples real quick here for you. So if you had a natural disaster and you had your home paid off, let's say wildfires in California or floods or things like that, things that aren't covered by your insurance. If you happen to have that happen to you and you had your home paid off, you just lost all your money. But if you had your money in a separate environment and that was to happen to you and your house got washed off the foundation or your house burned up due to a natural disaster, the mortgage lender actually forgives your note because there's no collateral anymore. They can only collateralize the land and the home. They can't collateralize you personally. Okay, so these are some really key things when you're looking at your mortgage that really just people necessarily think about. Okay, so I hope this helped you. Please feel free to comment below. Call me, email me. I'm here to help. I'm here to help you become more financially successful, and I hope to talk to you soon. Bye bye.